Hi, I'm Andrew Savickas, publisher at YieldTalk.com. Today I'll be talking with Matt Rodak, the founder and CEO of the alternative investment platform FundThatFlip. FundThatFlip is a venture-backed real estate investment marketplace specializing in short-term loans for residential real estate rehabbers. Prior to founding FundThatFlip, Matt led sales and marketing for a $950 million commercial property risk management firm. Matt earned a finance degree from John Carroll University and is a chartered property underwriter. Matt, welcome, and thank you so much for joining me today.
Thanks for having me, Andrew. Excited to be here.
Great. So, Matt, what inspired you to start FundThatFlip?
Yeah, so my story and interest in real estate investing goes all the way back to my teenage years. So I had a landscaping company in high school, and ended up doing a lot of work for people that were flipping houses and buying fixer uppers and keeping them as rental properties. So I got some exposure, on the landscaping side. We'd come in and we'd help them, certainly clean up the outside and the curb appeal, but also got some exposure to demoing out some of the houses and really got to see these homes come to life, right? From one of the more disgusting looking houses, if you will, on the block to one of the nicest houses on the block. And I thought that was pretty cool around, how these guys had a vision and could really turn around neighborhoods. And they were also never shy to tell me how much money they were making, which as a 16-year-old, 17-year-old was like, man, that's pretty cool. That guy just made, 40, 50K on a flip. And thought, man, that's what I want to do when I grow up. So went off to John Carroll, as you said, studied finance really with the goal to get into some type of real estate development. And I graduated in 2007, right when if we remember back that far, right when the real estate market was starting to kind of crumble in on itself. So weren't a whole lot of opportunities for me to get into, the real estate development world. But I had college bills to pay and needed a job. So ended up landing a really good job with as you said, a commercial property insurance and risk management company, and cut my teeth there in underwriting, and was fortunate enough to rise through the corporate ranks, if you will, to the point where I was eventually running sales and marketing for one of their middle market groups, which is about a 900 million business. And that business had grown exponentially over the years, and they hadn't really institutionalized their sales and marketing function. So that was my job. So I got a lot of exposure to building technology systems and CRM systems, and got to travel the world and really ride shotgun to the executives that were, running and growing that business. And I like to say it was kind of like my mini MBA, if you will, on the job, where I was fortunate to learn just a tremendous amount in a short amount of time when I was still pretty young. And I also I like to say that the biggest thing that I learned was that I did not want to be an insurance executive for the rest of my life. So started, putting a plan in place to kind of exit the corporate world and get back into something a bit more entrepreneurial, and core to my passion of real estate investing. So started flipping some houses and doing some partnerships, and frankly, even just working for free, right? To kind of learn some of the ins and outs of the business. And through that experience, learned of the hard money lending industry, or the private money lending industry. Again, if you go back to 2000, this is around 2012, 2013, banks don't typically make these types of loans because of short duration and the high risk. So there's this really almost cottage industry, particularly back in 2012, where you have these really small local lenders. The guy that we worked didn't even have a website. He didn't have an email address. You had to fax him, like no kidding, like fax him like this 8-page paper application. Then he'd get back to you in like a day or two or a week or whenever he felt like it, right? And oftentimes the response was, yeah, we don't want to fund that deal because we don't like the neighborhood. And it was kind of like, well, why did I need to fill out 8 pages of paper application, right? If all you needed was a street address. So short story is I experienced some frustrations as a borrower, and saw real opportunity to bring technology to bear to this industry, right? Everything from the loan application process to managing construction draws to making payments online, right? Simple things that we take for granted today, but even back in 2012, 2013, we're still, somewhat evolving in these niche industries. So some of my experience on the corporate side led me to believe that I knew enough about technology to be dangerous, from how we service the borrower and even data, right? And how we make underwriting decisions. I kind of saw where that was going. At the same time, I was doing some passive investing on the lending clubs and the Prospers of the world. And again, if you rewind all the way back to 2012, 2013, these guys were true peer-to-peer lenders then, where you could go in, you could look at the different loans, you could see the person that you were lending to and see what they were using the money for and their credit score. So I had a small portfolio invested on, I think both of those sites, and I'm getting a 9 or 10%, return after, these things do have losses, right? Because they're unsecured consumer
Oh, yeah.
loans. So I'm getting a 9 or 10%, return on these consumer loans. And my hard money guy was charging me 4 points and 14% interest. So 18% on an annualized basis. And my finance degree starts to kick in and say, man, I'm paying 18% on a first position mortgage with 20% down payment, right? Equity. And I've got these consumer portfolio of loans that's paying me 9 or 10% theoretically, which could all go to zero, right? There's no collateral. So pretty quickly it was like, man, it seems like this hard money lending industry is operating incredibly inefficiency, frankly, on both sides, right? There's opportunity for better experience for the borrower. There's an opportunity to, bring this new asset class to passive investors. And just thought, man, it seems like a kind of a no-brainer. The challenge at the time was, and I pitched the idea to my father-in-law, who's a former SEC attorney, and he loved the idea, but he said, it's really hard to sell securities online. And, you either have to jump through a ton of red tape, get a broker dealer license or a registered investment advisory license or file publicly, right? Or you're in a lot of trouble, right? Fortunately, and this is kind of where the stars really aligned for me, was there was this new legislation coming through Congress, which is now known as the Jobs Act, which created this exemption for small companies or any kind of company really to raise money privately, right, through what's called the Regulation D 506C exemption. So as long as you're raising money from accredited investors, you can now generally solicit, or, more commonly said, I guess you can advertise that you're raising money, right? So there's kind of this confluence of all of these things coming together: my passion for real estate, some of the experience I had in the corporate world, personal experience with trying to borrow money and personal experience lending money, just, led me to believe, man, if I don't try to do this right now, I may not be successful, but I know for sure I'll regret it if I don't try it. Yeah. So yeah, kind of put a plan in place, moved down to New York City, and figured what better place to start a financial technology company than in Manhattan. Started networking and building out the business from there.
Great. Yeah, your timing certainly was very good, and you're not the first person that I've talked to, and myself included, who kind of got into the space through the P2P kind of lending side of things. And then, I certainly can appreciate there's a lot of parts of the real estate industry that are still, pretty behind the times sort of technology. But yeah, it's the sort of fax machine moments are pretty eye opening.
Yep.
So, real estate's a fairly crowded part of the investment crowdfunding ecosystem. I mean, you talked about the Jobs Act, and that was, 8-9 years ago, and there's been a lot of new platforms emerging in all kinds of different places. What would you say sets, FundThatFlip apart from other ways that people can invest in real estate, and especially invest in real estate using those exact same kind of Jobs Act based opportunities?
Yeah, and I guess it's one thing to say the real estate market is crowded. I think the other thing that I may, have you consider is that the real estate asset class is the largest asset class in the world, right? Even the residential real estate asset class by itself, right, is a multi-trillion-dollar with a T, right, asset class. So we fundamentally believe there's plenty of space for, a variety of different types of platforms. And I think, right, so it's the market size, I think, is one thing. There's also a very diverse, different set of both asset types and investment types, right? So you've got everything from residential to office space to multifamily to light industrial, each of which, in my opinion, requires a certain set of expertise and knowledge to, properly underwrite and properly invest in. Then you've also got different places in the capital stack. There's debt, there's equity, there's preferred equity, there's mezz debt, right? So you start to kind of pull all these different things apart, and really leads me to believe that there's a lot of room for a lot of different types of players to serve the different segments and the different niches and the different, frankly, parts of the capital stack that are going to, have different risk and return profiles. For us, we, as the name suggests, FundThatFlip, pretty early on, intentionally decided that we were going to be focused very, very specifically and very intentionally on single family, so 1 to 4 family properties, and very intentional around debt, right? So the reason for that really is twofold. One, it's what I know, right? It's what our company knows. And we felt we could build enough expertise from an underwriting perspective to be really good at picking the right operators, picking the right projects, and structuring the deals appropriately. The other side of that is we fundamentally believe that as, investors that may be, being introduced to real estate investing for the first time through crowdfunding, residential assets, from a fundamental perspective, are pretty easy to understand, right? Most people, particularly if you're talking to the accredited in space, like they've probably owned a home before and they understand value, right? They understand, hey, if this fix and flipper is going to buy it for X, put Y into it and sell it for Z. It's kind of what you really have to understand, with a few other, nuances to look at. But that's much simpler than cap rates and discounted cash flows and rents and vacancies and all this other stuff that goes into more commercial type investing. So the learning curve, I think, is a lot flatter on the residential space for investors. The debt we thought made sense for this space because, one, the term of the projects tend to be less than 12 months. And two, the size of them, it's very difficult to actually manage and, for lack of a better term, audit equity, right? So your equity return is dependent upon the profitability of the project, which means you have to really trust that sponsor is being, reporting and truthful with the actual performance of that asset. Whereas debt, it's like, I'm going to lend you 100 grand, you're going to pay me 110 grand back, right? And like, that's kind of all we have to be comfortable with. So it's not to say that equity doesn't make sense in crowdfunding. I think it does in mezz. It's just, for this particular asset class, we believe that debt is the most scalable and it's the most manageable, and it's probably the best product, even for our customers, right? Our borrowers. Whereas, it's more of a fixed cost for your capital, as opposed to equities. It starts to look a little bit more variable depending on the performance of the project. So I think that's our main kind of differential, if you will, when you're looking at the different platforms, is this real focus on residential and real focus on debt. I think the other thing that I would add to that is we're one of the few platforms, I don't know too many, that have a direct origination arm and a direct retail platform. So why I think that's important is we have relationships with our borrowers. We get to know them, we get to qualify them, we get to really understand the project. And we maintain that relationship throughout the servicing of the loan, right? So collecting payments, and to the extent of workouts needed or an extensions needed, we have that really strong relationship that we've built from the beginning. And we're also committed to growing those relationships with our borrowers. So there are some other platforms that, right, purchase loans from other originators. So they have the crowdfunding or the peer-to-peer aspect of it, but they don't have the direct origination. And there's a lot of guys, right, that have the origination piece, but they're just selling off to institutions, or they've got a fund, or they've got some type of balance sheet. So we're one of the few that I think is important for really both sides of our marketplace that have really that direct connection with both of the customers, without, any intermediaries there to, one, take some economics, but also perhaps, not have the same information asymmetry, I guess, if you will, right? We know them both very well.
Yeah. No, that makes sense. And I appreciate the reminder that, it may seem like it's a crowded space when there's, 50 crowdfunding platforms, but the reality is real estate is just a huge market. And when you're talking about residential real estate, which is, last time I checked was, larger than US GDP by itself, then there's certainly implies there's a lot of space out there. And you mentioned something else about a lot of folks looking at this are new to real estate and may not have the vocabulary. It certainly was true for me. I look back and I didn't understand what those terms meant, what cap rate meant, what mezzanine debt was, what a capital stack was, and you can learn these things, but it takes some effort. For someone who is looking at something like FundThatFlip, what does an investment in FundThatFlip like really actually look like? What are they actually investing in? You talked about it's primarily debt versus equity. So what do I get if I invest $5,000 in FundThatFlip?
Yeah, so we've got a couple of different flavors, and I'll try to keep it pretty high level. So if you go to our platform, we originate loans, right? So like almost think of us as like a bank, right? So we work with a borrower. They're generally small business owners that have these real estate businesses, and they need to borrow money in order to buy houses and fix them up. So we'll finance the acquisition, and we'll also help them finance the renovation. And when we do that, we issue a mortgage, first position mortgage, and we issue a note, and we've got personal guarantees and UCC filings, and there's a lot of other technical aspects of what goes into that. So The investment that we as a company are making effectively, right, is a first position mortgage, just like a Wells Fargo might, right? If you borrow from them to finance, your house. The difference obviously is interest rate and term and some other things, but for all intents and purposes, it's a first lien. We've got collateral, right? And we've got recourse back to that asset if something were to go wrong. What you're actually purchasing as an investor is not necessarily like a fractional ownership in that mortgage. The industry and the lending clubs and the Prospers of the world came up with this concept, and the rest of us, for the most part, have borrowed it. But it's a security, again, to not get too much into the details, which is called a borrower dependent note or a borrower payment dependent note. Different platforms call them different things, but for all intents and purposes, they're all the same. And as the name suggests, what that note is it's saying, hey, there's this underlying mortgage, right, that FundThatFlip made to Andrew, right? And you're investing in $5,000 in a borrower dependent note that is dependent upon the performance of that underlying mortgage. So as long as that underlying mortgage is paying interest on time and eventually repays its principal, so too will your borrower dependent note. So it's not a direct ownership in, the asset in this case of the mortgage, but it's an efficient way to effectively pass through that security in a manner that makes our platform able to operate at scale and do the things that we do. So that's kind of the short version. We wrap all of that up in what's called an indentured trustee, and we have a trustee agreement. So there's some protections. It's called a bankruptcy remote structure. So there's some protections to make sure as an investor, you're taking real estate risk. You're not taking platform risk, right? So we want to segment that real estate risk away from the startup or the platform risk, so that if anything were to happen to our business, you as an investor who's assuming real estate risk is somewhat protected from that. So that's the first flavor. Again, they're called the borrower dependent notes. That is kind of our bread and butter. And if you go to our platform and you see a deal, you get to pick that deal, and you're investing in that deal, and you're investing in that deal through a borrower dependent note. We also have some fund offerings, which a lot of our investors, we've heard from them over the years of like, hey, we really like what you guys are doing. We like this asset class. A couple of things are important to us. One, diversification, right? And for me to build a diversified portfolio, I've got to invest in 10, 15, 20 projects. And I may not have the time for that, or I may not have the patience for that, or it becomes, too onerous for me to manage all of that. So can I just give you 100 grand or 50 grand or 25 grand or whatever the number is, and let you guys diversify that for us? So we've come up with two fund products in 2020. One is used to purchase these borrower dependent notes that I referenced on the platform. So for all intents and purposes, it's called the Residential Bridge Note Fund. It's just like another investor on our platform. It takes fractional ownership in these mortgages that we originate, and then effectively passes some pro rata ownership down through the people that have invested in the fund. And that's also structured as debt. So the fund raises debt through a note, right? And then uses those proceeds from the note to buy assets. Those assets produce income. That income is used to service the debt, from the fund. Another very similar fund, we call it the pre-funding note fund. So similar in a lot of ways. It's still debt. It's still secured by these underlying, first position mortgages. The difference is how we use that money. That money is used to pre-fund the loans, right? So we're going to originate the loan. We're going to, effectively give the borrower the money that they need to acquire the property. And then after we've done that, we're going to syndicate the loan on our platform, right, and recover that money, or we're going to sell the loan off to one of our institutional buyers. So the pre-funding note fund, think of it, I think the easiest way to think of it is like a warehouse facility, right? It's our working capital line that we use to originate loans. And there's constantly new loans coming on and older loans coming off of that line as those loans are either syndicated or sold.
Okay, thank you. And I'm glad you pointed out that the thing about platform risk versus real estate risk and understanding the structure of the investment, because I know that certainly there's room for lots of different variations on this stuff. And that's one of the great things about this ecosystem is there's so much innovation happening. But something I think investors, don't always fully appreciate is, the distinctions between how different platforms are structured. So in some cases, you really are essentially, you're putting money into the platform versus into one of these, like there's some different structures here that some investors might not appreciate. And I think, knowing that what you're doing, there is that sort of insulation and the trustee relationship that gives people some separation from, what happens with you and Fund That Flip is really important. So I was going to ask about the pre-funded loans, but you explained that, which was super helpful. Now, is there a minimum investment for investors looking at Fund That Flip?
Yeah, so the minimum on our platform is 5K,
Uh-huh.
which, I can speak more generally because I've been following the space quite a bit. I think it in the accredited world, right? So the Reg D 506C platforms that are primarily, available to accredited investors. I think on average, right, the minimum investment tends to be around 5K. Sometimes it's 10 or 25K for, different types of, particularly when you get into the equity type offerings. There are a number of platforms that are also available to non-accredited investors, for lack of a
Right.
better term, where your minimum, I think, goes as low as maybe even $10 or $100. But yeah, our platform is 5K, which we think is a good balance that allows the accredited investor to really, dip their toe in the water, see if this is something they like. As you said, start to educate themselves and learn about the process and how to think about underwriting. But also significant enough for us that, it's manageable from an overall, relationship perspective and different things like that.
Sure. And you mentioned that term, that it's open to accredited investors, and broadly speaking, for those who don't know, it means people who make about $200,000 a year or more, or have a net worth of $1 million or more. And there's some more than that, but at broad strokes, that's what it looks like. Do you have plans to to offer fund investments to non-accredited investors, or is it you plan to sort of strictly stick with that accredited tier?
For now, we're pretty focused on the accredited world.
Mm-hmm.
The way that the SEC has set up, the exemptions to allow non-accredited investors is a bit more onerous than we think makes sense for our business model. Primarily because of the short duration and different things like that, right? Where
Mm-hmm.
it's difficult to take in a large number of investors and manage those relationships and service those clients well. I think what is interesting and exciting is that the SEC is continuing to look at how they define what an accredited investor is, and
Yeah.
a new piece of the legislation went just into effect this past December that broadens the definition out to whereas historically it's been just around, like, as you said, net income
Mm-hmm.
or net worth, to also allowing for certain professional designations to qualify, right? So if you're
Right.
I believe if you're a CPA or a CFA or a Series 7 or Series 63, right? And at the end of the day, right, what I think is smart, and what the SEC is trying to do, because these investments are largely unregulated, is they're trying to protect people, right?
Right.
So the first way that they did that, and the easiest way, is to say, well, wealthy people can afford to perhaps make
Right.
some bad decisions and lose some money, and hopefully they're sophisticated enough to have advisors and different people to help them. I think it's also smart to say, hey, there's a certain number of people that are intelligent, right,
Mm-hmm.
and can make their own decisions, and maybe haven't reached that point in their income or their net worth yet. And I expect that the SEC will continue to broaden that definition through other means by which people can qualify, right? So I guess
Mm-hmm.
theoretically, right, anybody can go take their 63 or their 7, right, and
Right.
now you're an accredited investor. So in some ways, it is open to anybody that's willing to put the time into, right, achieve those professional designations.
Yeah, that's true, and it's actually I certainly I appreciate the need to protect people, but I also I for one welcome the idea of there being an actual kind of accreditation exam available. I mean, that was
Yep.
one of the things I think people don't realize, is that when you say accredited, it sounds like there's some kind of test, but there is no. I mean,
Yep.
historically, it's not. There's no test. It's that do you have money, basically.
Yep.
So I think it's a good development that now you got people who may not quite meet those traditional income or net worth criteria, but they may have a lot of expertise, and certainly are at least as sophisticated as other people looking at those asset
I think
classes.
that's the next step. And I think the
Yeah.
industry will do a good job of leading that, right? Of let's come up with, what is something that's maybe not all the way to a Series 7, but somewhere in between, where there's enough of a comfort level there that folks understand what they're investing in, and are reasonably well protected.
Yeah, absolutely. Now, what kind of returns can someone expect from this kind of investment? Is there ongoing cash flow, or is it just sort of a one-time payment once the loan is paid off?
Yeah, so our investments are typically anywhere from the 7.5% to 9% range on
Hmm.
an annualized basis. We make interest payments monthly, so they are
Okay.
current income. They produce some current income. Typically, how that works is we process payments on the 15th of every month for the previous month accrual period. So
Hmm.
um, right now it's middle of January, right? So next week we'll be processing December accrual period, right?
Okay.
So, and again, it goes back to that borrower dependent note. Our borrowers pay in arrears, right? So they're going to be making their December payments on January 1st. We give the 10-day kind of grace period that we offer our borrowers to see who's going to pay on time, right? And then we process those payments out to investors, according to who's paid. And of course, as late payments come in, as they do, we process those in more real time. But yeah, these are current pay, and then you get the principal at the end. So, that's the important distinction: is these aren't principal and interest; it's
Hmm.
interest only
Interest
payments
only.
throughout,
Okay.
interest only payments out throughout the loan, and then sometimes they're called bullet loans, right? Or balloon payments
Hmm.
is more commonly used in kind of the consumer world. That full principal then is repaid upon either sale of the home or refinance of the home, and likewise, right, the principal is returned at that point.
Got it. Now, you mentioned earlier that one of the things that's appealing about what you're doing is that it's the kind of investment a lot of people can understand because a lot of people have bought and sold houses. They sort of understand the concept of flipping a house and turning a profit on that. Um, at the same time, I think a lot of people are looking at their own sort of mortgage statements and refinancing and looking at what's happening with mortgage rates. What are the drivers for the rates that you're charging borrowers, and what's the kind of drivers for the rates they can expect on their investments and in that ecosystem?
Yeah, and that's a really interesting question. I think I mentioned, when I started, thinking about starting this company, I was paying my local hard money lender 14% in
Hmm.
4 points. And part of our company's thesis was that this market's operating inefficiently. It's probably not a 18% risk, right?
Right.
So what we've seen over the years, past 5, 6 years we've been running the company, is interest rates have really compressed, right? And I think a big part of that is, companies like ourselves have really worked hard to institutionalize this asset class, to the point where more money can come into it, right? So part of that is scale, part of that is data and standards, underwriting standards that are consistent right across the board. So we've seen those 14% come down to nines and tens, and in
Hmm.
some states even as low as sevens, which means obviously there's less yield to pass through to the investors.
Hmm.
But at the end of the day, right, our one of our missions, if you will, is to just create an efficient market. And if the market says that these things should be priced at 5% or
Hmm.
25%, it's really not up to me to make that determination, right? It's up to the capital markets, people that have money, effectively, whether that's retail investors on our platform or institutions, to say, here's how I want to price this risk. And on the other side of the market, it's up to the borrowers, right, to say, here's what I'm willing to pay, right? And here's where it makes sense for the numbers to pencil. For me, as I'm looking at buying this property and putting in the work that needs to go into it. So I think we're starting to kind of approach that point of like max efficiency after
Hmm.
5 or 6 years, where the weighted average rate that we charge to our borrowers is around 9.5, 10%. And maybe this is a good caveat into how we make money, right? We're typically going to take what's called an interest rate spread. So if we
Hmm.
originate a loan at 10%, we may offer that to our investors at 8%, right? So we're making a 2% difference in
Hmm.
interest rate spread. And we've also seen the origination fees come down pretty significantly. So the fours are now twos and 1.5s. Which is another big part of how we make money. Those origination fees primarily stick to us for our efforts around marketing and underwriting
Hmm.
and sales and all those good things.
Okay. Now, if someone is coming into this, without a lot of experience with real estate as an asset class, people may have owned a home themselves, but maybe aren't experienced in investing in, hard money lending, for example. What are some things that someone new to real estate should know before making their first investment in a platform like Fund That Flip?
Yeah, and I think the way I like to think of it is like start kind of top down and then work your way into kind of more specific. So I think the first thing is have a perspective on some markets, right? Like I just moved from New York City down to Washington, DC, and like we're not doing a whole lot of funding in New York City right now as we're, 8-9 months outside of the pandemic, because there's a lot of people leaving, and generally real estate prices, move with jobs and move with people, right? So I'll never bet against New York City long-term, right? But just right now, there's just a lot of uncertainty. At the same time, we just hired people in Charleston and Charlotte and Boston to develop those markets, because we have a perspective that those markets are where people are moving and where jobs are being created and where there's supply constraints around housing. So I think the first step is try to develop, some perspective on what markets you like, right? Based on whatever thesis that you may come up with, but I don't think it's rocket science, right? It's follow the jobs, follow the people. And like, that's where real estate's probably going to do well. And then maybe look into a little bit more around, and all this data is available online, and we try to do a good job of presenting as well. What's the monthly supply of inventory of for sale housing, right? And, historically, a balanced market is going to have 5 to 6 months worth of supply. Most markets right now are at like 2 months, which means there's just not enough houses relative to how many people want to buy them. So most markets are benefiting from, some supply constraints. So that will change, right, over time, but keeping an eye on both supply and demand side being where people and jobs going, supply being, you can quickly look at, NAR stats and different things like that of what's the supply of the housing and what's coming online. After you've kind of figured out your market, I think, now you can start to get into more specifics around the deal fundamentals. And again, this really isn't rocket science, which is why we like the asset class. It's, how much is the borrower paying for the house in its current condition? Do I believe it's worth about that much? Right? How much work is the guy putting into the house to bring it into highest and best use? Do I believe that number is enough, right, to bring the house in its current condition into the condition that it needs to be in to sell relative to the other types of properties that are selling in that market? And then third, what do we think that house will sell for once it's in that renovated state, right? So I'll use some terminology here, right? We call the first one the as is value. And then we call, the second one, the renovation budget. And typically on our platform, we produce what's called a statement of work, an SOW. So that SOW is going to show what's going to, go into the house, very, very detailed. And then the last number is what we call the ARV, the after renovated value, or the after repaired value. So the first thing is like, do I believe those numbers? Do I believe those are good starting points for the investment? And then once you believe that those numbers seem reasonable, right? And there's Zillows and Redfins and a lot of different places that you can do your own homework. The next thing you're going to want to look at is, okay, how much are we lending against that value, right? So when we make a loan, let's say the guy buys the house for $100,000. The first thing we're doing is, do we think the house is worth $100,000 in its current condition? If it is, how much do we want to lend against that $100,000 value? And typically we're going to lend somewhere between 80 and 85% of the 100K in this example. So 80 to 85%, which we think is enough money for the operator to have skin in the game, which is important to us, but two, quite a bit of cushion to protect any type of downside, right? So it's first is like, what's that? I'll use another terminology, LTV, loan to value. The value being, what's the value of the property today, right? The second number that you want to look at is then what's called your loan to ARV. So what's the loan going to be on a percentage basis once all the money's out relative to that after renovated value, right? So the home's now fixed up. We think it's going to be worth 200K. How much loan are we going to have out at that time? And our typical kind of ratios that we're trying to stay inside on that one is 65 to 70%. So when all the money's out and the house is finished, we now have somewhere between 30 and 35% margin relative to what's called our attachment point, right? So we attached it, 150. We think the property is worth 200. We've got a 50K kind of margin there. And that works out to whatever that loan to value ratio is. The third number then is the loan to cost. So that is cost in this equation is, what is the person paying for the property and what are they putting into the property? So if I'm buying it for 100, I'm putting 50 in, my total cost of this project's 150. how much are we lending on that 150, right? So again, typically we don't want to be north of 90%. Most of our loans are 80 or 85%, which means that throughout the life of the project, the borrower's bringing, right, another 10 cents for every dollar that we're advancing against the construction draw. So that, again, kind of goes back to that skin in the game. At the end of the project, in order for that operator to get his 10 or 15 cents back on every dollar, he's got to sell the property, refinance it, whatever. So it keeps us very aligned with our incentives of ultimately getting to liquidity. So it's kind of loan to as is value, loan to after renovated value, and loan to cost. And if you can get comfortable with all those three ratios after you've kind of gotten comfortable with the the market. And by the way, these exercises can be like quick, right? Like 5, 10, 15, 20 minutes once you get good at it. Then you may want to look at borrower's credit score and how much experience do they have and have they paid back, previous loans that we financed for them. So then there's some of these more qualitative kind of things that are somewhat quantitative, I guess, that, you can also start to kind of build into your decisioning process.
Sure. Yeah. I mean, I know a lot of these terms can feel foreign to people coming into the space. I mean, they certainly were for me, but you sort of come to appreciate that, it's not that different from someone investing traditionally and coming to understand what is a PE ratio and what does a book value mean. I mean, it's just understanding the vocabulary of the asset class. Now, what are some of the biggest risks that investors should know about before making an investment in a fix or flip?
Yeah, so I like to say the biggest risk for this asset class in my mind anyway is liquidity risk. So you're making an investment and you're not going to get your principal out until the borrower can either sell the home or refinance it. And if you've ever watched any of the HGTV shows, right, and they do a good job of dramatizing this, right? But like there's always problems, right? And those problems can manifest in a number of different ways, but it's very possible, right? You're investing in a 9-month loan or a 12-month loan that turns into a 12 or 15 or 18 or 24-month loan. Because, either the borrower needs more time to get through permits, or they took some drywall down and found something they didn't expect, or, whatever the case may be. So it's not an asset class. And I think this generally applies to all real estate that, you should be putting money into if you think you're going to need that money, back quickly, right? It's there's some unknowns that could draw the project out and ultimately your return of principal out longer than you initially anticipate. So, I think liquidity risk is something that, and frankly, I think this applies to a lot of alternative assets, right? Is that's the trade-off you're making for probably slightly higher returns. And then there certainly is principal loss risk, right? These are investments that are paying, 8s, 7s, 8s, and 9s for a reason. So sometimes things go wrong, right? Where things are uncovered that we didn't expect. A lot of our challenges that we've had in our book, and we haven't had a whole lot, but are tend to be partnership related, right? So like any small business, sometimes there's two people, and one of them has a view on one thing and the other one has a view on another thing, and it creates more challenges for a project than are really needed. So there's certainly some principal loss, but I think of the 1,500 loans we've repaid, I think we've returned like 99.4 or 99.6 of principal. So it's somewhat negligible to some extent. But your real risk, I think, in my mind is more often, I shouldn't say more often than not, I think 26 or 27% of our book extends right past maturity date. So there's going to be a third of your portfolio, right, that maybe takes a little bit longer than you initially expected.
Yeah, that's super helpful to understand. I mean, it's certainly reassuring to have stats like and a lot of platforms will tout this to say, 99% or 100% of principal returned. But, I think there's more to be done to help educate investors, especially those new to the space, about how often. I mean, that was certainly, again, maybe it shouldn't be a surprise having been through various home repair projects myself, but just realizing how often, how common it is for projects to run behind, and what you think is going to be an investment that's intended for 6 or 9 or 12 months turns into 15 or 18 or 24. So it's. I was going to ask you if you had statistics about how often those things run behind, but it sounds like it's not a small number. It's north of 20%.
Yeah, and frankly, I should be clear too, right? Like we use term of the loan also as a risk management tool, right? So we may set a loan term at 9 months, knowing full well the guy probably needs 12. And we do that because when we get to month 9, if we don't like the way the project's going, we've got a lot more tools now in our tool belt to incentivize the borrower to do the right thing, or at least the right thing based on our opinion of the loan, right? So, an extension sometimes, and I think we're working on this, we can do a better job of like explaining when that's the expectation, right? Like, hey, we know it's a 9-month term, but we really expect it to be 12 or 15 months.
Yeah.
And typically there's some additional compensation for that extension as well, right? So typically the borrower is going to pay an additional point for another 3 months. And we do share that extension fee with the investors, right? So it does help your return on an annualized basis to get, effectively, what equates to an additional 2 points of annualized return. So there's typically some compensation when things run long for that inconvenience, if you will. I'll give another shameless plug here a little bit that I didn't talk about when I was talking about our funds. So this is another thing that we tried to solve with our fund offerings. So if you invest in one of our notes that go into either the PFNF or the RBNF, those do have very defined maturity dates. So if you've got a June 30 maturity date on one of those notes, your principal is coming back to you on June 30th, right? So in addition to the diversification thing that we heard a lot was important from investors, this other thing was like, I want more certainty around when I'm getting my money back, which is, one of the reasons we designed the fund as debt as opposed to equity, because it gives us a lot more flexibility around, giving folks that, that defined maturity date.
Yeah, no, that makes sense. And I think that's been a welcome development in the last few years is seeing more fund options for investors who, it's not a small amount of work to look loan by loan and make those decisions, and the ability to do that broad diversification, with one check is nice. And the targeted liquidity is a nice feature as well. Now, on the other side of the equation, what kind of borrowers do you typically work with, and why do they choose, what you're doing and Fund That Flip over, a traditional hard money lender or other kind of financing options?
Yeah, so we're primarily focused on the segment of the market on the borrower side of professionals, people that are doing this as their full-time jobs, right? This is how they put food on their family's table, and it's all they do, right? So they typically have acquisition teams and acquisition channels, and they've got either in-house employees that do the work or relationships with a lot of contractors. They know their markets incredibly well, right? In terms of, what neighborhoods are gentrifying and where there's opportunity. And typically they're liquid, right? So we're really focused on the type of borrower that's, typically doing 4+ projects a year, and likely over $1 million of transactions a year. And our value proposition to them really is a couple fold. One, it's because we have the capital relationships that we have, we literally can offer them infinite scale, right? So particularly when you're talking about a lot of the local hard money lenders, like they have a balance sheet of $20 million or $50 million. And like when they're out of money, they're out of money, right? And like they may have to, turn someone down. I think the other interesting thing about this business is you look at the top 20 lenders in the residential kind of hard money space, they've only got about 18 or 20% of the market. So a lot of this market is still very like private money, right? So like Andrew, a guy that flips houses and maybe you lend him 50K and like you and 2 other guys kind of like lend him money, right? So like a lot of our borrowers are borrowing money from, call it family and friends, right? Which is one, time consuming for them, but 2, doesn't offer them a lot of scale. So, that's kind of selling point 1. I think the other differential that we have, and it goes back to, our earlier conversation on our specialty, is because we have such a diverse capital stack, right? We've talked a lot about the retail platform. We also sell loans to an insurance company and to a publicly traded REIT and to some hedge funds, right? And each one of those markets has a slightly different buy box, right? So if you've got really high credit and a lot of experience and your project's kind of down the fairway, that REIT wants to buy it all day, right? And like that REIT's going to have the cheapest money, right? So now as a borrower, it's like, hey, you can come to Fund That Flip. And one, we're going to be able to say yes to you more often than maybe a traditional, hard money lender, because our box is broader because we have all these capital partners. And there's a lot of overlap for sure, but it ends up overlapping kind of on a broader basis because, these different groups have different risk tolerances and what they're willing to take on relative to the returns they can get. So we call them story deals, right? Like sometimes these deals, they come in and like, they got a story that goes with them, right? And they make a lot of sense, but when you put them on paper, it's kind of like,
Hmm.
how am I going to explain this to the insurance company or the REIT? But it's a good deal, right? We like the deal. And if I had unlimited amount of my own money, like I would invest in this project. And, we can do those deals because of the retail platform that we have and the broad base of investors there that understand what we're doing and different things. So I would say that's, two of the biggest differentials. And then obviously you've got to be competitive on pricing and leverage, which again, kind of given our diverse capital stack, we very rarely lose deals on price or leverage.
Mm-hmm.
And then you factor in some of those other things, and I think we're pretty well positioned in the market for the borrowers.
Okay. Now, earlier you mentioned, things are not particularly active in the New York area right now, for example, but things are happening in Charlotte and happening in Charleston and happening in Boston, and there is a lack of supply right now. How have you seen, how has the pandemic impacted your business, and how do you see it continuing to affect your business and the industry in general over the next 12, 24 months?
Yeah, I mean, I think in a lot of ways it perhaps accelerated a lot of macro trends that were already in play, right? I think we were already starting to see people migrating out of the Northeast and parts of kind of the Midwest and the Rust
Mm-hmm.
Belt for a lot of reasons: jobs, weather, retiring, et cetera, et cetera. So I think what happened, and I can use myself as an example. Like we had always had plans to move back to Washington D.C. It's where my wife's family's from,
Mm-hmm.
but it was 2 or 3 years from now.
Right.
And then COVID happened, right? And now I'm in DC, right? So it accelerated our plan. And I think, that's the case for a lot of, perhaps New Yorkers and some other people, right? That are spending more time in their homes and, had plans to go elsewhere. And this was a catalyst to do that. So I think it's really interesting right now because the big question that I don't have the answer to is the reason for the supply shortage, because, we pulled 12 months or 24 months worth of demand forward, right?
Mm-hmm.
All at once, right? Is that going to leave, right, a trailing demand gap coming behind it? I don't have the answer to that. I don't see any indication that will happen. I think the other, big macro, and demographic change that was really starting to take hold was the largest generation right now in our country is the millennials, right?
Mm-hmm.
The mid to late 30s through the late 20s now. And what's happening with that generation, again, my generation, is we're growing up, right? And
Yeah.
we're starting families, and we're finally paying off our college debt, and we're tired of the 2-bedroom apartments, and it's time to move into a house, right? And you're either buying a house or you're renting a house, but it doesn't change the equation around there's demand for single family housing.
Mm-hmm.
And the second largest generation behind the millennials is the Gen Zers, right, which is coming right behind. So I think there's going to continue to be a pretty large pool of demand that's coming behind, and not to belabor the point too much, but the housing shortage has also been caused from the 2008 crisis. We
Mm-hmm.
underbuilt about 3.5 million homes over the last decade.
Right.
So just to get back to even, we got to build 3.5 million homes to catch up. And then you got to add on to that, right, the additional demand coming from the the millennials and the
Mm-hmm.
Gen Zers. So I'm remain pretty bullish. And then you factor in a very low interest rate environment on top of all that. And there's going to be also massive amounts of wealth transfer from
Yeah.
the older generations to these generations. So I'm pretty bullish on housing long term. I think there are some markets that will have some shorter term challenges that had probably gotten too hot,
Mm-hmm.
leading up into this period. But I don't see us having a 2008 experience. I think it's going to be more market specific if there are some pullbacks.
All right. Well, thank you for that perspective. So, one last question, Matt, and I'll let you go. And it's something I do try to ask all the guests who join me. What's your favorite book about money or investing, and why?
Yeah, so I mean, I think there's two of them that kind of came to mind. I think the first one is Think and Grow Rich. It's an oldie but a goodie, right?
Mm-hmm.
Napoleon Hill.
Sure.
I think it's pretty topical to some extent around how to become an accredited investor. The other one that's also topical, which is Rich Dad, Poor Dad, right?
Mm-hmm.
And I think, the opening line of that book is the rich don't work for money, right? They get their money to work for them. I think also it's just a really cool book and opened my eyes when I was getting my real estate career started, but also kind of plays into this idea of what you're doing, right? Helping people with passive income and alternative assets that, can help people not work for money and have their money work for them. So I think both of those are highly recommended.
All right. Those are great suggestions. I would certainly second both of those recommendations. Well, thank you, Matt. I really appreciate you taking the time. It was a pleasure catching up, and I learned a lot. Thank you.
Thank you. Thank you for having me, Andrew.